So this is we're going to do a webinar presentation of what we were going to do in person due to the coronavirus. So this is what I was going to discuss. It's Thursday, the 19th of March, 2020. And I want to go through where our outlook is for the market and how we're seeing things. Obviously, it's been extremely volatile. People don't know what's happening, and there's obviously a lot of change. But I think there's a major cycle changing at the moment, and people need to be aware of what could lie ahead. So we're going to discuss that today. So what I want to cover, I'll go into a little bit about who we are and what we do. But ultimately, market positioning and where was the crowded trades, what were people doing? The virus, obviously, the coronavirus that's sweeping the globe at the moment, what that's done to the market. This is a black swan event, once in 100-year event that's basically looks like it's going to end the longest bull market of all time. And we're going to discuss things about that and the economic indicators around that. More importantly, though, I want to discuss looking back, lessons from history. And the problem you get normally is people start to look at the very short term and near term, and right now they're looking at case numbers and death rates and all the rest of it. But what are the lessons from history that people can pick up from this event? And then we'll discuss the framework that can create and what's going to potentially come for the market cycle, business cycle, and debt cycles, and then how, I guess, people can position and what they're going to do for that. So just quickly about who we are. I set this fund up for the Progressive Global Fund, and 51 Capital manages it, basically because I thought the market was late cycle. We thought, you could see a period where things are going to change a lot, and you need to be able to profit in all those markets. So capital preservation was always the focus. That's our primary goal. It's majority of my wealth and a lot of clients and family and people are in the fund. So the goal is always to preserve capital and then look at generating returns, ideally above 10%. We use an absolute return long short strategy, so we don't worry about benchmarks or other things, and we essentially need to try and make that return regardless of what the market's doing. So we set up the fund because essentially I didn't believe anyone could ever care about our capital as much as others could. And people get pressured into taking risk through various mandates. And normally people get caught up in the crowd, and we try and think differently and do things differently. And hopefully in this what's coming, that will position us very, very well. So just quickly, we started in 2018. We've outperformed the market and the majority of our peers in that time. And as I want to talk about, what's worked in the past isn't going to work going forward. And I think people need to reassess how they are positioning and what they're going to do. So where were the markets? What were we seeing? Since the GFC, which is, the great financial crisis of 2008, 9, interest rates have gone down. They've gone lower and lower and lower, and central banks have essentially forced people into taking more risk to generate return. From a survey that was done that I went to from PWN, I found this very interesting, that most people still want to generate a 10, 15% return. And that's down from 20%. And we're in that category as well. It's normal that people need to generate return of that magnitude in retirement and normally, in order to retire and live off their assets. Otherwise, you can't work forever. So, but when you look at the risk-free rate, that's a 10 to 20 times the risk-free rate. It's negative in Europe, and people just get forced into taking excessive risk, and it made this huge bubble across all asset classes as people took more and more risk on to try and generate returns. If rates were 5%, would people be taking the risks that they were doing? Probably not. They would be leaving their money in cash and a good portion of it, or fixed income, and earning a return that wasn't going to risk their life savings. So the bull market, we thought, was very late in the cycle, and it was the longest bull market and one of the strongest in history. This is the US market. And at the time, there was excessive optimism and what we believe was a detachment from traditional valuation methods. And in all cycles that turn, people always think this time is different. Technology's advanced, or various things have changed, or interest rates will stay low forever. It's a new world that we're living in. It always drives this excessive optimism, and we were seeing that. The other things that happened, obviously, there was a lot of debt in the system, and this is primarily driven from the corporate sector. So in the GFC, the private sector had a lot of debt, but this time corporates and governments are at the end, I guess, of they've taken on a lot of this debt. And you were seeing a lot of financial engineering, which you normally see at the end of a cycle, in terms of share buybacks and things going on. So in September, the repo market, which is the short-term financing market that a lot of these institutions use, there was major problems going on. They couldn't, the rates started to spike. There wasn't enough cash in the system. So the Federal Reserve had stepped in and, it's just been providing quantitative easing again. Every time that they've tried to take this off, it's gotten worse. So at the time as well, and last year, the yield curve started inverting. This was a typical sign of recession warnings. And we were already looking at manufacturing data, and business cycle looked like it was turning. So things were starting to deteriorate. Unemployment was as low as it thought it was going to get. So it was sort of only a matter of time until these things started to crack. um, bubbles always end with euphoria. And unfortunately, a lot of people in short selling, when, markets are running hard, it's very difficult to try and maintain a sense of rationalism when fundamentals didn't matter. And these are two stocks, obviously Tesla and Space, which is a Virgin Galactic. These things were going up hundreds of billions of dollars in market cap on essentially no real fundamental changes. And when, I guess, retail investors and bullish people get extremely bullish, expecting these things to last forever, and it's all going to be, I guess, great. That euphoria typically is what happens at the top of a market, as you've seen in previous history, the 40 years, bubbles across all the various aspects. So as we mentioned, we were seeing corporate profits flatlining or trending lower, but stocks were going up, which is a short seller's worst nightmare. Because obviously the fundamentals deteriorate in businesses, and it didn't seem to matter because interest rates are so low, stock market's on a tear, everyone's making money. But I think now, obviously, with the equity market deteriorating so hard, people are going to see how these changes now play out, and I think fundamentals will matter again. So, at the time, we were looking at things like the Fed probability of recession was obviously spiking, the purple line here. PMI, so that was falling, Purchasing Managers Index, that was already showing people were getting a bit more nervous. Below 50 is a contraction, so that's that red line here. And unemployment was at record lows. This has happened at the start of every recession, and normally there are signs that start to show cracks in the system, which we could obviously see. And then the virus has now been the catalyst to trigger a lot of these things, and we expect this to now deteriorate. So the equity markets, as we said, were basically being supported mostly with corporate buybacks. Companies were taking on excessive amounts of debt. They were getting finance from the pension system. People were looking for return. Oh, bonds are safe. Boeing's going to issue me debt. They're going to pay me, whatever the rate is, 3-4%. It's better than zero in the bank. People were taking on this risk, expecting these things to go on forever. And that's just not going to be the case. And now that the sector's turning, it's just going to change. So the corporate debt levels on the balance sheet at the moment are very, very high. And these guys are going to have to try and refinance into a market that potentially is not going to be there. So I mentioned Boeing just as an example, because obviously the airlines are now getting significantly downgraded, and they're talking about major bailouts, companies are going to go under. These are the buybacks that Boeing had done post the GFC from 2013 onward. They've taken on excessive debt and done huge amount of stock buybacks. As you can see, their debt's just skyrocketed to over $25 billion. Now, the company, now that the airlines have crashed, has obviously cratered from $400+ down to it's about 100 at the moment. This is an old graph, and now they're screaming for a bailout. So these guys have taken on all this debt. They now have a weaker balance sheet than they normally would, and the stock's getting downgraded. And they go down from AAA, BBB to junk, and the rates are going to pay a higher. So as you pay higher rates, the credit spreads are going to blow out. So as these credit spreads get wider, which is the rate that companies can finance against, the government risk-free rate, which essentially is going to be at zero, the treasury spread is going to be far higher. So in the GFC, what happened even prior to it all getting bad, as these banks and things started to collapse and collateral was getting more risky, people wanted a higher rate. So as these rates get up higher, more and more of these companies are not going to be able to refinance and live on the debt. I mean, on $1 billion, or Boeing as example, 25 billion, the more and more debt you start taking on, and the higher rate, every incremental change just destroys value for the equity holders. So these guys are now going to say, "Oh, we'll bail us out," and we think there's potentially some major problems that are going to arise in the sectors due to this, because how are the politicians going to look at these bailouts, and how's it going to be seen upon where corporate executives get rich because they give themselves share options and stock buybacks and just increase their own value of their own equity portfolio, when the workers are now going to go under and companies go under in the tax-funded bailout. So yeah, we'll get into more about this later, but I think there's going to be some major problems come in the next part of this cycle. So obviously the market, and this again is probably slightly older, but when the market popped, it really popped, and to be honest, I didn't expect it to fall as fast as it has, but it shows you the fragility in the system at the moment. And I believe this is now probably the fastest bear market in history. So when I saw, the virus, we were following it closely, and people were, saying to us, what are you doing? What are you doing? We sold a lot of our long book down because we've written about this in our previous letters. You can follow it on our website, 51capital.com. Our previous investor letters, we were talking about what we were doing and how, the disconnect in fundamentals just had us questioning what was coming. And we sold down our long book significantly. And if we hadn't, the performance would have been significantly worse. I think we were crunching the numbers just before this. It would have been, 10 to 15% worse, depending on various things. And obviously, if we'd shorted a bit more, it would have helped us a lot more. But our view was that central banks were propping up markets, and it was hard to get real price discovery. And just as an example, the Chinese market is actually up after this whole virus thing. So it's very difficult times, but we could see these things starting to break, and the bond market was pricing in a lot more risk than the equity markets. So we were saying that volatility is going to rise, and we could see it spreading to the US. And then we thought the market's probably going to dip a lot further, but ultimately it was still very early on. But we were saying it's time to start maybe panic early, because if this gets crazy, it can get real crazy. And obviously the markets have fallen over 30% in that time period. And we normally people have been in a very stable market of low volatility, and it's going up and up and up. But if I asked people, if a global shutdown for, and no one knew this uncertainty, how long it would last, 2 weeks, 6 weeks, 8 weeks, 10 weeks, however long, a year, what could end the market, and what would the impact be of that? And people were chasing, value stocks and things that look cheap and buying stuff, but I don't think they're seeing the big picture here, and that's what I want to talk about today. So when a bear market starts, they normally do not last for a month or 2 or 3. They normally go far longer now and further than you think. So when the yield curve inverted, that was a sign to say, hey, maybe things are going to get worse. And obviously it was a bit shaky, but it eventually blew off, as do most times it does. It continues to go higher, and it'll trend higher. But momentum dies off on some of the indicators in terms of the people participating in the market. And obviously now that the bubble's popped, we're down 30% year to date. But what's the outcome, and how bad can it get? And these unknowns, no one knows. I don't know these things, but this is the part that is concerning. So as an example, it can get a lot worse. And people are now starting to say, oh, well, we shut down the whole economy, could it go into a major recession, depression? Well, the only time the equity market's fallen, as much or more than what it has now, I think, was the Great Depression in 1929, which obviously the market had a major fall and then would rally, and people think, oh, it's back to normal, it's all good again. And then it proceeded to fall another 89% from peak to trough. And we're only down, 30 odd percent at the moment. This is a percentage indicator overlay of the S&P 500 and the same period through 1929. And as you can see, if this goes on for years and years and years. There's stark differences, and I will talk about them, but there's also some big similarities. So I just took this off, I think it was Wikipedia or something, just saying, what happened in the Great Depression, and let's have a look at some of the similarities. I'm a big history studier, and I think you learn a lot from history, and that's what will help people from separate the noise and what may go on. So government and business spent more in the first half of 1930 than the corresponding period of the previous year. Right now, you could argue that's exactly what has happened. So you just change the dates. Basically, then they suffered a severe loss in the stock market and they cut back their expenditures by 10%. So the wealth effect now from people losing 30% of their super funds and savings and investment accounts, which is terrible, is going to have an impact on how they spend. And in the shutdown, they're going to eat into savings, weddings are getting cancelled. And here they had a major drought that ravaged it further. And I've just said, well, that maybe we were having a severe virus that is, ravaging the economy of the US. So rates had then dropped to such low levels, but the expected deflation of asset prices and reluctance of people to borrow meant that consumer spending and investment were depressed. So I think this is going to continue. I believe that our generation, or the younger generation, are going to be similar to people that lived through this period, and like in Japan at the moment as well. And I'll get into that. They're not going to like having debt, because why would you have debt and buy assets that depreciate? People will not do it. They will get into a change of mind frame. The baby boomers, who control the majority of the market and money, they're going to get in a period of protection. They don't want to take risk. They can't take risk. They've got to save what they've got. Their nest egg for retirement. And so looking back, the decline in the economy pulled all the countries down, and then protectionism's happened. The tariffs, which obviously has also been happening now, and I laugh, well, not laugh, but Donald Trump is now saying, "Oh, the Chinese virus." He's starting to call it the Chinese virus, not the coronavirus. I mean, you can see what's going to happen. He's going to make China the scapegoat for the problems, which again, even during this period, it's similar to what happened with Germany in World War prior to World War II. They, were made the scapegoat for the cost that they caused the global economy in World War One. So again, I can see these problems and tariffs rising again as they try and rebuild their economy and put pressure on people that have cost them. And obviously, it's an election year, which probably raises tensions and makes it even harder, and may exacerbate that problem. But ultimately, once panic and deflation set in, people believe they can only avoid losses by keeping clear of the markets. And they're going to run and hide and hold cash. And, ultimately, the majority of people that speculated on assets aren't going to speculate on assets. People are buying the dip because they're used to it, but they say, oh, buy when there's blood on the streets. There is blood on the streets, but people still believe that it's going to go up. True blood on the streets is when no assets are ever going up again and everyone is so over it. That's the true bottom. So are we at that point? I think it's bad, but I don't think it's gotten that bad yet. And people need to, start to look at some of these things, and I'll get into it more. So look at a cycle, and I'll go back on to the Great Depression and why there's some differences, because obviously what happened in the Great Depression was they did not print money and stimulate early enough to provide stimulus or get them out of the depression, which they should have done. They were too busy trying to balance the budgets. This time is going to be slightly different. History doesn't repeat exactly; it always rhymes. But they are not going. They're going to print too much money, so you're going to have a different problem. So looking at the cycle, business cycle turns down, as I was showing it was starting, and now obviously the whole world's shut and on lockdown, and a lot of people are going to lose their jobs. Just today, Qantas laid off 30,000 people. This is going to continue. Cafes, a lot of places are going to start to suffer. Retail, but essentially the whole economy stops for an extended period of time. What's going to happen? The central banks obviously cut rates. RBA's meeting today. All these central banks' rates are going to zero. They're going to try and give people mortgage relief, but ultimately defaults are going to rise. People can't pay their bills, and as I showed, the credit spreads are going to widen further. This forces people not able to refinance, and then it's going to cost more. So what do? They have to sell assets to pay down debt. So already I'm hearing stories of guys, trying to sell properties, or they're accelerating the sales of shares, and they need to sell down, and the liquidity that gets withdrawn creates this negative wealth effect that just exacerbates the problem further. So as the deficit widens at the government level, because tax revenues have now fallen, and obviously they're going to stimulate, and they've got to spend excessive amounts of money just to keep things going. It's almost like a wartime effort. People start to get really worried, and capital starts to flow out. So as unemployment then rises due to the layoffs, and obviously this is an impact of the business cycle turning as well, the government's going to print money and try and stimulate. And in previous, since the GFC, the currency hasn't really devalued as yet. But this is the last lever, and this is what I think people don't really understand, is this is the last lever and last part of a major deleveraging. And I'll talk a lot more about this. that you're going to see massive currency debasement across the globe. Then the result of all the defaults is there's going to be debt restructurings and asset write-downs. There's going to typically these sort of things start to get toward more the bottom when you reset the equity, people are going to get wiped out, and then those sort of assets get written down to a point that they become attractive again. So eventually, the interest rates will actually start to rise because they're going to have to support the currencies that go into free fall. And what happens when the rates rise? I mean, everyone's saying, "Oh, I can pay 10 times forward sales right now, or 20 times or 25 times EBITDA multiples, or things like that, because rates are zero." Now, tell me what happens when rates are 4 or 5% to stop inflation from the currency devalues as well, to get a floor, a bid under the currency. People will start to pay normalized values again. So you might go from the top of the band, 20 plus times or 18 times PEs, down to say 11. I mean, coming out of the GFC, you couldn't even buy things 10 times as expensive. So I think those sort of changes are going to still happen. And eventually what happens is assets do become cheap, the currency will stabilize, and that's the time to buy and get long, great businesses. I mean, these are good companies, don't get me wrong, but you're going to fight a wall of money coming out. And as people are forced into selling, as you're seeing right now, to pay down debts, I just think it's going to get worse. So negative rates will cause deflation, and it's going to weaken the banking system. Every single crisis has a banking crisis that escalates it. Things can be bad, but until people start to worry about the banking issues, that's when it starts to escalate. So, the business cycle turning down is already going to put huge pressure on the corporate financing market. And the difference between equity markets and credit markets, people are either willing to lend or they're not. And when lending is defaulting and people get nervous, the credit market seizes up, liquidity is withdrawn from the system, and then bad debts start to rise because people can't refinance and they have to force sell assets. So, one of the changes around the world and in Australia by the IMF is in the GFC, people did bailouts. So the government, taxpayers will bail out these banks. There is still the chance that depositors may bail out banks should it get that bad. Obviously, the bank balance sheets since the GFC, they've learned a lot, and the laws have been there to improve it. But they always say the same things, that the balance sheet's strong, people can weather the storm, etc. But when a crisis comes, they may use depositors to bail out the banking system and restructure the equity, which for clients, I'm happy to discuss a lot further and talk about how I think people can position for that. So again, people run and put cash in the bank. Is it going to be safe? And these are the things that people don't even look at or think about. As a money manager, I certainly do. You have to start looking at your counterparty risk in crises, and are these people good for the money? So, and again, I'll happily speak to people if they want to talk to me about these things. Interest rates at zero, which they're all going to now, is basically a floor. So what happens is real rates actually start to rise because of the deflation. And I mean, the oil shock at the same time is going to cause huge problems around the world. As I said, the credit spreads will widen, debt service becomes more expensive, right at the same time that no one can get money. So the deflationary pressures on asset prices is just going to rise further. And I mean, you've even seen things like gold and even now bonds are selling off because people are trying to get cash out of the system. So everyone's trying to get out at the same time. Now, in America and other places around the world, the pension system has been the buyers of most of these things. So as all the baby boomers are coming into retirement, their pension funds have taken on a lot of the, I guess, they have been the buyer of this corporate debt. They have been buying, things up continually, trying to fund the payments they've got to make out with the assets they've got. They are underfunded. They are going through this period now. They will have to be restructured. There's going to be government bailouts of the pension system, or you're going to see even more problems because all the but the retirees who are relying on these pension payments of, call it $5,000 a month, could get cut down to $1,000 a month if these guys don't have the ability to fund the system that it's broken. There has to be restructurings. So the crowded trade at the moment is everyone has got so much debt. Everyone's been buying the same assets, chasing the same things, looking for the same returns. And I think you're going to see a massive unwind in asset prices further, and the pressures on the financial system. Obviously, the virus will go away, but I do believe that the pressure that you're going to see put on things and certain parts of the industry that are already at breaking point, just due to the equity devaluation, which is similar to the 1929 crash, the major shock, companies are going to struggle, and there's going to be major debt restructures down the track. And just to talk about deflation, I mean, Japan, they call it the lost decade. Their equity market still never exceeded the highs that it was in. And the crowded trade, everyone is in these market tracking ETFs, low fee paying, index following funds. Yet, I mean, why would you want to own something like this in a deflationary cycle? It makes absolutely no sense. To me, being in the crowded trade is not where you're going to make money. You need to be ahead of everyone else. So, and I'll talk more about this as well, but Japan's market topped out after a massive bubble that blew up the stock market, a similar percentage rise to what you've seen now in the US equity markets. And now we fall in the same amount. Things do bounce. You do get a bounce, but then ultimately, this market fell for 1, 2, 3, 4, 5, 6, 7 years, and it's, barely even recovered. People have changed their mindset. They do not want to speculate. And there's also some demographic drivers here, aging population, less young people. Countries that have a younger generation and net migration will recover, I think, sooner than this, but you need to have a major washout, and this is potentially what lies ahead for the Western world. So, and I'll talk a lot about Ray Dalio's book, and I've pulled a lot of things from his Understanding Big Debt Cycles, which, prior to that book, researching and understanding and studying these credit cycles and debt bubbles and bursts throughout history was always a lot harder. There is other books, and I've mentioned some of them in here today, but you've got to understand history and cycles. So basically, these major debt cycles last 7,500 years. So, I mean, the last major bust we're talking about sort of 1929. It's 90 odd years ago. And has it been since then? I mean, people can make up their own minds, but I think we're probably coming to a point where debt's going to really change the world. These mini cycles in between, I think we're potentially at a major change, and you're going to see a very big deflationary cycle, because the more debt there is and more credit is essentially, the more credit you have on your credit card or anything, people can spend more. So if you can spend more, things go well. But if people don't have access to the credit and the debt market sees up, they don't have credit to spend. So they don't have, income to pay back this debt. If they don't have a job and things start to change, you can see this cycle going down and down and down, which is, similar to what happened in Japan. People don't want debt, because why would you, buy $1 million house with tons of debt? If it goes down to $500,000, there's just absolutely no point in doing it. So people don't speculate and take risk on. They change their mindset and want to hoard cash, and they live a much more, I guess, reasonable lifestyle. So in the short term, people use borrow money to invest in assets and all sort of things. As the present's good and everything's good and people feel good, they're happy to take this risk. But as their debt burdens become too big and they need to deleverage, when prices fall, unemployment rises, which is what's about to happen, they're going to be less inclined to take on debt. They get forced into selling the assets that they speculated on because they can't cover the debt repayments. And then the collateral value of their houses or things or share portfolios or cars or whatever it is that they bought falls below the value that they bought, leaving them in a massive hole. So they don't want to take on credit. So until that washes through, there's just going to be a period of restructuring that needs to happen. So who's running this show? So Donald Trump, I mean, he's been touting the stock market going up and up and up, and that's great. But I mean, he's been bankrupt, several times. He has taken on more debt that he's ever had, defaulted on interest repayments to bondholders and others, and declared bankruptcy due to cycles turning. Cycles turn, but this is the same thing. So now, you can basically pressure governments and Federal Reserves to print and print and print money. How can you ever go broke if you can always print the money? What's the impact of that? And that's this part of the cycle that we're in. Helicopter money, giving everyone $1,000, and Hong Kong just did it. everyone's about to use and print so much money that it's going to cause currency debasement this time. I cannot see how that's not going to happen. And that's what we believe is the next part, and I'll talk more about that. So the US Federal Reserve's balance sheet since the GFC has, gone up substantially. Quantitative easing 1, 2, 3, and then they said, okay, we're going to unwind it. And when they started to unwind it, the equity markets, started to rattle, and they can't. There is no buyer of the debt except for them. And now this was where when we saw this was the repo operations. They started to support the market again and provide liquidity, and it all started going up. So don't fight the Fed. I mean, the stock market in this period has risen massively. Now they're talking, I mean, this is, over $4 trillion of debt, 4.3 trillion with a T. Now they're talking about a $5 trillion stimulus. So you're going to take it to $9 trillion. Now, what happens when rates rise? How do you ever pay this back? So your debt to GDP, right at the same time that GDP is about to fall, due to the virus and shut down, unemployment rising and the business cycle turning, the things are going to skyrocket. So the only way they're going to pay this is by printing money. So you have to default or you devalue your currency. So, and these are just things from Dalio's book. I thought I would just, include some paragraphs and highlight parts. And it's available, I think, in a free PDF. If you just search for it, Understanding Big Debt Cycles, you can go and read yourselves. But these are the parts of a very long book that I think, matter. So as the depression begins, debt defaults and restructurings hit the various players, especially the leveraged lenders, which, banks particularly, but there's a lot of them at the moment. And then lending turns into a run on the institutions, the banks, which I've said, every financial crisis always has the same things, and they always, fuel gets thrown on the fire when there's pressures on the financial system. So when they cut rates now, which they've done to zero, it's not going to work because the floor on the risk-free rate has already been hit, zero. Credit spreads rise, interest rates on risky loans go up, the debt can't be serviced. So the interest rate cuts don't do much to help these people, and lending institutions in particular. As the liquidity problems arise at this part of the cycle, debt defaults come and austerity must happen. So people start to sell assets and spend less, and you start to go in a deflationary cycle. This, not balanced with obviously stimulative measures, which they're obviously doing right now, causes debt monetization. So printing money is all that's going to happen, and it's going to cause inflation as you give everyone money. So I was going to say, pardon me, I've got a cough, but it's not the virus, I don't think. So, as we get into this next part, everyone seems to think the same thing. Oh, look, things will get better. Everyone's just going to move their money back into the market. They'll take risk on the books again. It's all going to go back to normal. But that's wrong. That's not the way it's going to work. The psychological change right now, I think, is so material, and from the calls and people I've spoken to and listening to stories in the markets of and business owners, people are going to change. And while it's short-term, heightened panic, all these things, I think as the credit market turns further, these changes are not to be underestimated. And the supply and demand of credit is going to dwindle. I can't see people taking risks to speculate on assets when they start to fall. So you need to study the cycles, and you need to know history. So what comes next? Right now, central bank is going to produce a lot of money, as I showed. This is going to cheapen the value of money, and it's going to make creditors worry that they're going to get paid back less than what it's worth. So if I lent you, $100 and I can buy 50 Big Macs with it, and now my currency drops, and say I can only buy, 20 Big Macs with that same $100, the purchasing power of my dollar has dropped. So now I'm in a terrible situation as a creditor who's lent money out. I'm going to be in a terrible situation as my dollar's devalue. So the debt defaults and restructurings then hit, and fear starts to, escalate further. And this obviously right now is a heightened sense of panic, and obviously the virus is terrible and all these things. The hospital system, the measures they're taking now to save lives, which is, in wartime efforts and things, everyone bands together and does these things. But the impact on the economy that comes next is going to be so substantial. It's hard not to see how such a stretched system that has got so much debt in it can get through this next part. So everyone scrambles for cash, and there's a huge liquidity crisis, which is going on now, and why the US dollar is, flying up, because everyone's running to safety. They've got to pay debts. A lot of this debt is in US dollars. They're trying to get credit where they can. Basically, the next part, incomes and borrowing are not enough to meet the obligations, so assets get sold, and that's what's been happening as well here. Spending gets cut, leads to fall in asset values, raises the value of the collateral, because if you own an asset that's dropped a lot and it produces less income, the value of it is less. So as a lender, I would want more security, or I don't value that security as highly, and then that reduces incomes further as well. So it starts to spiral and feed on itself. As borrowers become less creditworthy, lenders are more reluctant to lend, and this goes on, self-reinforcing. So what's next? Right now, the bottom 90% have essentially the same amount of money as the top 0.1%. The top 1% would control all the money. The period that's coming, the haves and have-nots are going to get massively spread out, and obviously as inflation and things happen and asset devaluation happens, where people have been told, buy properties, they go up forever, speculate on assets. When they get in a cycle of, hey, this debt's not worth what it says, this asset's not worth what it said, I'm paying back something that's worth less, I think you're going to see a major change. And I think, they're going to tax, the socialist sort of regime, I think, grows, and they're going to start to take money and increase taxes on wealthy and other things to help the bottom end of the market, which is probably normal through this cycle and will happen. But it causes huge dislocations and tensions in societies. So what I think will happen, obviously they do emergency lending. As I was saying, they restructure and do bank mergers or putting them into special purpose vehicles to restructure. And then this one, the losses imposed on depositors is the one that I was mentioning earlier. These are the laws that have all been changing. So, in 29% of the cases, this is the depositors did the bailout, call it socialist bailout. Is that the next phase? I think this time, potentially that's, a third chance. It's probably, maybe higher than that, given that they've changed laws to do this stuff. And then obviously they restructure, and, IMF can bail people out, and other, there's going to be a lot of countries that do it. But, these contractions last a long time, 55 months, it's nearly 5 years, say, and this is on average. It ranges, but obviously this has been a major cycle and a major change. I think it could last longer. So what's the next part? I mean, the average Forex, foreign exchange decline value versus gold is 44%. So, I mean, gold is in an inflationary environment is going to go up substantially from here. And this is the gold price, index at the time. So if you're arguing that 0.0 is now at the top of the market, and maybe we're slightly just past that, if we move into a depression phase and people are going to, what's the gold price going to do? It obviously looks like it's going to rally a lot. We could potentially be at this part as well, where stimulus isn't mattering. But ultimately, I think, we've probably seen the bubble top out, and we're going to see this. I mean, people ask me the question, and when I say, the US dollar could devalue substantially, people are so, the dollar's always so safe, and we're going to stay there and never goes down. It has before, and it can. And so where do you go? People say, where do you go? I mean, what other currency is good? And, we'll talk a bit more about that, and currency is very difficult, but physical gold, if you can transact and it stays the same value and people are willing to pay more because everything's devaluing, I think it'll have a good period ahead. And it's about hedging the portfolio in various aspects to diversify across hedging your bets. So talking about pushing on a string and, deleveraging and zero rates, why they won't work, this is the part late in the long-term debt cycle, which I think that's why I mentioned we could be at that part. Struggling to convert the stimulus policies into actually increased spending, so giving everyone money and going, go spend, let's get all the things back to normal. People aren't going to do it. I mean, they've got problems. The economy enters low growth, return on assets are low. The spending's not going to go there. So the biggest risk at this stage is you actually print too much money, which is the monetization of the debt, and that's going to cause a severe currency devaluation relative to the deflationary alternatives. This happened in history. It's just about looking back. So it's either going to be an extremely ugly deflationary deleverage ahead, or they can potentially balance it well and the stimulus may work. And I could be wrong. It could work. But it's hard to see at this point how that's going to happen. Now, I included this part as well because they talk about account and reserve currency countries, so the US dollar, have inflationary contractions. So can they have these, depressions where the dollar will fall? Typically, they can, and it happens later in the deleveraging process. So are we at a point where we're at the end of a major long-term 100-year cycle or a very, very long period of leveraging, and now we're at a stage where it's going to deleverage? As I showed you, the balance sheet, $9 trillion or whatever it's going to blow out to, how are they going to do it? This is caused the dollar can devalue when there's sustained and repeated overuse of stimulation to reverse deflationary leveraging. So they're going to try and stop, as the price is falling, they're going to print, 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 print. And I think this is going to be a time where the dollar will fall. And the trade-off between inflation and growth is going to be difficult because, if you print more, there's going to be higher inflation. So, gold should do well through this period. Plus, people start to take money out of currency. So, being a global money manager, and I don't know if you look at the performance of people that have held US stocks and assets in relative to Australian dollar terms, have far outperformed. They've done so well because the currency, our currency, the Australian dollar, I mean, it's 55 cents today, has fallen so far. What happens when the headwinds change and people own these assets and everyone's trying to sell to get their money back because the dollar's actually going down? So there's less incentive to hold it. And in particular, US treasuries. So US treasuries, which they use to finance the deficit, if the dollar is devaluing and these things are yielding essentially zero anyway, or 50 basis points or whatever they are at the moment on the 30-year or 10-year even as well, if you are getting such a low rate of return and your currency is going to drop, say 30%, what is the incentive to hold it? You want to take your money out, and that's where you're going to potentially run into some serious problems. So look, eventually things will get to normal, but it's not for a long time, I don't think. And it's sad to say, but I think if people don't look at the cycle and understand where you're at, then things are going to get hard, I think. So and can get a lot worse. So it's about taking action and understanding, are we potentially at a point where there is a major economic change to society as we know it? So normally it's very slow, takes a long time. Obviously the market goes up a long time. It's been going up for 10 years. So why should it take less than 5 or 10 years to normalize? We need, generations to get older to come through to people to change. And that's why they call it the lost decade. So I think it's going to take a long time for people to take risk again in equities and in properties and in things. And until people hate debt and there's true blood in the street and they hate assets and never want to own them again, I don't think you're at a bottom. So, the length of these drawdowns can last a very, very long time. And you're going to see huge changes in GDP. And I just included this to just show, the correlation between having an aged population in Japan and, the relative, decrease in property values as a result. So, baby boomers are at the stage of their life they can't risk assets. If it starts to fall, is that going to have impact to property markets around the world? And potentially until people are willing to speculate again, or they become cheap enough and too attractive relative to rates of inflation as well. So a lot of things are going to be needing to be considered in the period ahead. I just use this as well. This is from another book called This Time is Different, which, as I was saying, I heard that a lot last year, and this time is different. It's a dangerous 4 words. Essentially, in Rogoff's book, they talk about high inflation, currency crisis, and debasement of currency go hand in hand. Capital mobility, so the ease of getting money from Australia to US or anywhere, or Switzerland or wherever, exacerbates domestic banking crises because people can get their cash very easily, and things can look a lot worse very quickly. Periods of deflation due to the business cycle pop or shocks, like in this time I just included once again a virus. This time is different. It's probably not. So this has happened many times throughout history, and quiet periods, as you saw, with low volatility, don't extend indefinitely as everyone thinks. So in this, in this example, inflation crisis and exchange rates, they do travel hand in hand, and I think that's probably probably the next phase that's coming. So the crowded trades. So again, I've taken this from the PWN survey, which I found really good, just really interesting. I've set up a absolute return, long short fund or hedge fund, and people don't even know what these things are. They don't understand, like, why would you do that? And it's so easy to make money in markets. Why wouldn't you just do that? So the greater fool theory of someone's always going to pay a high price for my assets, I think those days are coming to an end very quickly. People can't justify paying, buying Sydney property for $1 million, or a 2-bed or probably a 1-bed apartment, miles out of town that just does no rental yield or cash flow that pays back debt. The only way it goes up is you're speculating on asset prices going up and the availability of credit remaining there. And this is going to be true across all sorts of parts of the market. So the crowded trades, being in direct equity and direct property, I don't think they're going to do well in the period ahead. If you have a period of 5 or 10 years of markets heading down and things are going to get really tough, unless you can short sell and invest globally, I struggle to see how people are going to make money. And that's exactly why I set this fund up the way we did. People, we call it an insurance policy, and hedge funds have gone under in the last few years because they have a short book. So if the market's going up 30% a year and you're running, you're short selling companies, you're losing money on those positions as they go higher. But people don't take out insurance or don't think they need it until their house is burnt down. So we think hedge funds are going to have a really good time ahead, or absolute return funds, long short funds. They're all the same thing. But if you can't see what's coming, and I think positioning for it, I just think people are going to struggle to make money. And through those cycles before, people have been doomed to repeat the same things that have happened in the past. If you sit there with your head in the sand, I think people could have a really bad time ahead. And I still read all these guys on CNBC or news networks or AFR, and I guess hearing stories or other funds, or people have differing opinions to what I do, and that's fine. I don't mind. We aren't here to feel good and pat each other on the back. Our job is to protect our assets and make money on what we think is going to happen. Hope is not a strategy. Hoping that the market is going to go higher and all things are going to go back to normal, when I think there's clear signs of what is coming, they're going to print an obscene amount of money. To not think that things can change is, I think, a major problem. Did Donald Trump study history? I highly doubt it. I mean, the guy's been broke a number of times. He was saying the virus it's going to be under control. It's not going to be an issue. And then saying, it's the biggest stock market rise in history. The market's, down here now. And he's talking about high stock market all the time. Is that going to continue? Look, I struggle to see how things are going to change or stay the same with the amount of printing of money that's coming in currency debasement that history has proven. So, the framework's there. It's just about working out what to do. And as I said, it's a lot cheaper to panic early in the cycle than panicking 5 years down the track and you're down 80% on your values. So you need to weigh up the probabilities and work out the best way to position. The future's never certain. I do not know if these things are going to happen. The volatility is extremely high at the moment. It's extremely doom and gloom out there. I joke that no doubt the day I tell everyone the market's going lower and for 10 years, it's probably going to rally and go up 5 or 10% from here. But we're not in this for the short term. Putting money with a manager who has a view, cycles are going to change, things do change, markets change day to day. Right now, they're changing almost hour to hour, extremely. These sort of things can cloud judgment. And I think it's about finding managers who, I guess, you agree with or hedge your bets across things. Don't, if you stick your head in the sand or say, this person knows what they're doing or doesn't, I think people are going to make big mistakes. So the uncertainties are there. You can't know everything. I don't know what the impact of the virus will be, how long it's going to last, but I can certainly take the virus out of the equation right now and see how much impact it's going to have. And, hearing about people being laid off and unemployment's going to rise, the crowds are going to be all caught in the same thing. And I think they're all going to be hoping for the same bounce. And unfortunately, I just think, given the volatility, it's looking like it could, get a lot worse. So the questions are really, is the stimulus going to work and without inflation? Again, I don't know, but I think based on what you've seen in history, it could might be a very different scenario this time. As I said, the pressures on the banking system are going to be extreme. I think even China, they say, oh, the virus is gone and it's all good now, but people have been locked away. Right at the same time, I think a lot of companies are going to potentially move their production offshore to other countries, take less risk. Demand has dropped off a cliff. Are people going to be buying goods from there? I think their banking system is going to look really shaky, and it has done for a long time. Their balance sheets essentially gone up. The reason the whole world has boomed so much, and Australia in particular didn't go into a great recession, was get a GFC, was their balance sheet expanded from $3 trillion to $33 trillion, and they just keep, I guess, kicking the can down the road. But can they survive this? I'm not sure. And these are the questions that people need to ask. So I just say it's probably better to think about it in terms of a scenario analysis. The bull case, so this is I think the majority of what people think, and this is the norm, the normal thing that has happened and what they're used to. The virus gets contained, disappears in 10 to 20 weeks or something, and everyone goes back to work. Nothing happened. It's all good. Back to work. V-shaped recovery. Stimulus has saved the businesses. No one really goes under. They lose their job for a small amount of time. The inflation doesn't come from the stimulus, and investors aren't concerned that the budget deficits are there and governments are broke. And the central bank balance sheet doesn't matter. They basically say it's all good. They focus on high growth stocks again and say rates are going to go low for ages. So we're all going to have to go back to the stock market again. So let's get back in, and stocks are going to go back up. I think this is a very low probability event based on the shock, and I think the longer the shock lasts, which is an unknown, no one knows, but it could be a lot worse. The bear case, I think the absolute worst case is the virus isn't contained until later in the year, and potentially even next year it comes back. And I think if there's no vaccine, panic goes up, hospital systems get overwhelmed, a lot of people die, and panic remains for a long time. Policy response causes inflationary pressures or stagflationary pressures where asset prices fall, and there's a major currency crisis around the world. China's banking system collapses. That's going to pull down essentially all the other global economies, and the whole world's going to go into a major depression. And unemployment will rise as defaults skyrocket, and people essentially are bankrupted. US dollar collapses. Interest rates are pushed higher to contain the inflation, and debt gets restructured. I think the bail-ins, bailouts of the banking system happen at this point, and as I said, the world could fall into a depression that lasts many years. And I think ultimately the gap between social classes, and I think the shocks in the government could even see a war from such things, and that's probably the absolute worst case. Is that going to happen? Again, I think it's less likely to have all those things. I think it's going to be a mixture of the two. I think the base case is the virus will eventually get contained, but it's probably going to be until next year. They'll have a vaccine. They will, the healthcare system will be able to cope with it. They're going to do the measures that reduce the number of cases. They'll be spread out over a longer period, and things will be okay. I think that stimulus measures will be somewhat effective in the short term. Obviously, there's some things happen at the moment with these liquidity makers who essentially have not been able to access liquidity, and due to the shock, and that's what's caused a lot of this volatility. But I think as those issues get fixed somewhat, and people start to think, oh, things will get better, and the bull case people are still there, and stocks look cheap, there will get bids back into these things, and potentially you see a bit of a bounce. But for now, the narrative is about the case numbers, and there will be some issues there, and obviously volatility will stay high for now. But the stimulus may help, and people don't go under, and less unemployment. So I think it works to a point. But then, as I've mentioned, I think capital flows are going to go out of the US. I think the currency is likely to devalue. It's almost going to be a global debasement of currency, because they have to do it to spur on internal economic activity. And cost of real goods is going to rise due to the supply chain shock. So I do feel like asset prices will fall, but inflation is going to be an issue for goods that people are all buying and rushing to buy. And if they're giving everyone $1,000, do the prices of TVs go up, or prices of food or real goods? Probably, and that's a stagflationary environment, which wouldn't be good. But that's yet to play out. I then think you're going to see these debt restructurings. That's highly likely. Banking system is going to come under pressure. They have been strengthening their balance sheets for this exact thing. But I think that's going to be the cause of the next downturn. As you see these defaults and lending still remains tight, you're going to see a major crisis start to unfold. So, we think that I think China's banking crisis could bring a major downturn, and tensions are obviously going to rise between the US and China. I can already see just the way that Donald Trump's calling it the China virus, that probably is going to play out in the future. Let's see, but it's hard to see how he's not going to make China the scapegoat for the problems the US is going to go into, especially in the election year. So I expect people are going to be less willing to take on debt and go into an asset protection phase. I think people are going to really worry about what they're exposed to, and this shock is, especially if it gets worse, they're not going to be able to take the next part that comes, which is going to be really hard on a lot of people. But it's about managing risk and portfolios and expectations, and we're going to talk a bit more about that. So right now, we have been extremely, as I said, asset protection first and foremost. And we've done relatively okay through this part because we took a lot of risk off the book. It would have been nice to have been significantly shorter, but we've reduced those shorts now into the market turmoil. The market has fallen the fastest it's ever fallen. And while we still have been looking at some shorts now, it is difficult to see. I mean, some of these things that we've looked at have rallied significantly in the last few days. The volatility is really high. Again, we don't need to be too smart. So we're holding, nearly 60% cash. Physical metals, gold and precious metals make up a good part of the portfolio. Uranium, again, this is an inelastic commodity, huge supply shortages. Even in a depression, you can't turn the power off. So these prices should remain strong. We then have some mining exposure. Again, this is a smaller part. Precious metal miners could go up significantly. And then we've got some asymmetric positions that we're in that I guess could revalue significantly on catalysts or not in this environment. So we think that the short book will probably grow again. As the US dollar devalues, gold is probably going to be more attractive. So we're talking about we'll probably increase this even further as things settle down, and there's value to be found. Inelastic commodities such as uranium, as I've said, we should do well through this period. Even oil, buying physical oil and things in an inflationary period can be a good place to park money because it has a use and people will need it. Companies, I think are going to find it really difficult to refinance as things settle down and we start to get a bit more, I guess, normality. Smaller businesses that are listed that have, really bad balance sheets, I think are going to go under. So our net exposure, we'd like to probably start running much more closer to market neutral. And our short exposure is going to increase significantly as the opportunities arise and things start to settle down. As we've been saying, this is the first innings of a major change. This could last for years. There is no need to be rushing into things and taking excessive risk right now, and that is why our cash balance is so high. So we think there's going to also be pressures on the banking system. That's going to cause a lot of shocks. But again, until the volatility dies down, it's better to try and preserve that capital as best we can and sort of just take good opportunities as they arise. Throughout the cycle, things like healthcare and defensive assets typically do well through these periods. People still need to eat and they still need to treat their sickness and do other things. But again, it's going to be there's obviously a very high period of volatility at the moment, but it will probably subside. The problems in the short term are being addressed by the central banks. And we were sort of talking, if you read back our last note, while we were saying this was all going to happen, in the short term, we didn't enter this with a huge short position just because, as I said, central banks have pushed markets up. in hindsight, it looks, kind of silly, but when you look at the Chinese market, which we did have positions in, it's actually been up since the period. So it's hard to know exactly what's going to happen. And as I said, we're talking about a long-term cycle here that we think is going to play out over years and years. We are a manager that has a view, and we'll continue to do and position for that view to play out. And it's about taking good risk-reward opportunities and being defensive. So, as I said, the cash balance will be invested over time. For now, volatility extremely high. There's no need to step in front of a freight train and try be too smart, and just find these businesses that are going to struggle and build up the short book over the next period. And I think hedging things like obviously the Swiss currency, we'd probably think that places that people will go to if you get currency devaluation, places like Switzerland, places like physical metals will do well. So we'll continue to look at assets that will do that through cycles. And as I said, we've studied a lot of this stuff, and throughout these periods, they do typically do well. But it's about hedging the bets and focusing. No one actually knows what's going to happen, neither do we, but we have to take a view, and we're a bit different to probably what everyone else thinks. The market will be good and go up forever and it's all going to be fine. I think the shock's going to be too big to combat. But we'll hedge our exposure across the way, and our goal is to just generate those 10% returns regardless of what the cycle is doing, and that's the plan going forward from here. So, what to do? Everyone sort of asks and says the same thing, and asking questions and saying, "I've never seen it like this," and it's been the fastest drop in history, so no one has. So I think taking yourself back from the situation is good. Don't panic, I guess, too much. The time to panic early is gone. I think stimulus will come in. As I said, the central banks can get a bid. Right now, the measures they're taking haven't been working, hence why pushing on a string normalization period, as I mentioned through the books, is probably more likely, because the measures they're taking aren't working, and there's just a rush for liquidity. But as these big market makers are getting the adequate liquidity and the redemptions slow down, you will get people value buying and picking. Nothing goes up or down in a straight line. So at some point, we do expect the market to bounce and recover. And in previous drops, they normally have a bit of a bounce to a Fibonacci level. Just if we're looking at technical analysis, just to try and pull things back, just to say, hey, you just calm down. I think these are roughly where you might get to. And again, the way we sort of say to people is, if you do think this is going to happen and you are concerned, you can do things in thirds or quarters, or you don't have to do it all at once and worry. You just do it over a set period and make a plan, and you'll feel a lot better. But if you're complacent and you think it's going to go up forever and you don't think that something like this could happen, then what are you going to do? What's the contingency plan? How are you going to position for something like this? How does that impact your life? How reliant are you on asset prices increasing forever? The view is that if these things play out over the next period, then are people positioned accordingly? And can you stomach that? And how have you hedged your bets for this sort of scenario if it plays out? We don't mind if the market does this, or if it does go to new highs. We'll obviously make far less money if it goes up forever. But if it goes the way we think it will, then we should do far better than most others. And that's what we're planning for. And as you can see, we're extremely conservative how we're positioned. I think things are going to obviously probably still be very crazy with the virus stuff, and very much concerned about safety of elderly and making sure that we do the right things. But the economic impact I worry about even more. And I don't want to see people go through hardship, but I understand that it's probably part of the cycle and it's necessary. But I think people can mitigate those risks. And when people say don't panic, it's normally the time to panic. So I don't think it's you can take a step back and take some breaths. I think people can work out for themselves what they think, and you need to position accordingly. Nobody knows what's going to happen, but are people considering the downside risk? No one thinks bad things can get worse. And I sort of say to people, well, no one thought the Great Depression was going to happen. And then after World War I, which was the war to end all wars, it wasn't called that until World War II happened. because then they said, oh, well, it wasn't supposed to be another war. So things happen out of the ordinary. You just need to prepare for it. You need to manage your risk accordingly. And I think people just need to think about things properly. You need to look at cycles. You need to learn from history, and just be smart. So as I said, I think we're in the first innings of a much different market ahead. People who realise or see that early are obviously going to do a lot better. As I said, you don't want to see people suffer through the period, but if they're speculating and taking too much risk on and have too much debt, they've been forced into these things, the crowded trades, they're probably not going to do well. Paying no fees to be in an index that's going to go down for 10 years. I just don't understand why people, if they want to do that because it's cheap and, the index always goes up and stocks always go up and property always goes up and you just want a basket and don't want to think about it, that's fine. But, if it doesn't go up for 10 years, don't whinge to people and say, oh, well, why has it I've made no money over 10 years? I just think active management has died in the last, period where interest rates are low and everything goes up. But in the time ahead, I mean, if you can't pick stocks and pick cycles and pick, the right asset classes to be in, especially and manage risk in what's ahead, people are going to make far less money. And hedge funds, this is exactly the reason we set this up. What lies ahead is the period where we're going to do well. So I always say to people, you can draw a line from February backward and just put a line through everyone's performance and start to think, if this is a new market and a new time ahead, what are people positioning going forward? Past performance that people were in is not going. You are buying into a fund. We are mostly cash right now, and we've got a view, and we're going to stick to that view, and we need to make money through this cycle. And I think a lot of people are not. And our view is that if you don't think like that, and you're not, if you think the market's going to go up, obviously you'll do better. But you need to position and hedge it. And I think the cycles you can learn from history, and I always say hope is not a strategy. So we've set this up. We're ready for what's coming. And we think hedge funds are going to do extremely well over the next period. And hopefully we can prove that with our performance. So everyone thinks the same thing. It is crazy out there. I've not seen markets do these things, and the volatility has been more than we thought. But to us, it only adds more so to our thesis that what we're seeing is probably a major change of cycles, and things are going to change significantly in the future. I think we're very well positioned for that now, and I hope others can do the same. I do. You don't like seeing people lose a lot of money, but if what we say plays out, it could get worse. So not many people agree with us. Others all hope and think it's going to get better. And I hope we are wrong, because it'll mean unemployment's going to be a lot lower and everything's going to get a lot better. But I'm not in the business of hope. We're in the business of being real, and we need to manage money and manage risk the way we think it's going to play out. And that's our hedge. So I know a lot of people probably thought we were going to be a bit more positive about things, but we saw this virus expanding early. I thought about the economic impacts of it. Can you shut the entire global economy for weeks on end without major problems when everyone's got so much debt? You can do it if everyone's got cash balances, and they're not going to be forced into selling assets. But as you've seen from the volatility, there's far more debt out there than what people think, and I think things are really, really stretched. So if you're interested in investing with us, we are open, we are growing. We're happy to talk to people and try and help people through it. Obviously, so Darren Reid is our BDM. You can email investor@51capital.com. You can read our stuff on our website. We provide updates all the time as to what we're doing. We don't think it's time to try and take excessive risk. Just be smart about things, position well, and just hopefully make return and get through this next period. That's going to be really hard. I think there's going to be some really exceptional opportunities at the bottom, but that's a long time away. And when no one ever wants to own assets again, we'll probably be buying the same way that we were getting out of everything when everyone wanted to buy them. We tend to be quite contrarian. I think that's where you're going to make money. If you follow the crowd, you're gonna struggle. So hopefully we can do well for our investors over the period. I mean, obviously I'm a big investor in the fund myself, and I'm certainly planning to keep it that way and grow it over this period, because this is where fortunes get made. And if you can call this part right, there's going to be some amazing businesses and amazing assets to buy at the bottom. But we'll do that when people are restructuring and forced into it. So yeah, hopefully, people will take heed of this message, and it's a bit of a different opinion. Happy to pass on any details of the books or things that we've read, and happy to discuss things about investment if you want to talk to me in more detail, how we're going to position and things we want to look at about investment. You're more than welcome to. And obviously for clients, you can always reach me. So happy to speak. Hope everyone keeps safe out there. No doubt. Let's hope this is the bottom for now, because I'm posting a video telling you it's all going to get a lot worse. So um, let's hope that that's the case. But if not, just make a plan. And if you have a plan, you'll feel a lot better about everything. So know the downside, know your risks, and speak to us soon. Thanks.